Like we're
All right.
live.
Good afternoon, everybody, and good morning from Dallas, Texas. We have our friend Dimitry Gershenson, based out of Portland. So, good morning to him. We're going to start in a couple of minutes. I know we're getting people trickling in, but as a reminder, this is a off the well, this will be recorded conversation, so I won't say it's off the record.
On the
So
record.
Dimitri, we'll follow everything you're saying for this exciting webinar, but we will record this and this will be shared on our website at earthx.org. But in a minute, I'll introduce myself and then we'll kick off this conversation. So I'm glad that everybody joined us today for one of our first few webinars that we've been doing through EarthX. So if you have a lunch, you're fortunately off camera, so you can eat your lunch. You can have your drink. You can have your snacks. If you have a breakfast, you can have your breakfast. Um, and then Dimitri always has a cup of coffee because I know he's grinding. So,
Tea, man.
all
Tea.
right.
I'm a tea guy.
So why don't we start just in the interest of time? So good afternoon and good morning, everybody. My name is Vikram Agrawal. I'm the Senior Director of EarthxCapital, which is the innovation and investment part of the environmental nonprofit EarthX, which you guys are all familiar with since you're joining our webinar today. Our main focus is on how do we catalyze impact and have really pragmatic conversations that are impacting folks on the front lines here in Texas, around the country, and around the world as it relates to the environment, sustainability, conservation, clean tech, climate, all topics. And today we have a really special treat because we have a conversation with Dimitri, who basically straddles both being an innovator and being an investor. And Dimitri, I've known for a couple of years, and he was giving me guidance when I first started looking at sustainability and clean tech several years ago on what was going on in trends. Um, we're going to skip bios just in the interest of time. I'll let Dimitri talk a little bit more about himself and what he's doing. But today's discussion is really going to be focused on how do you navigate what's going on in the world today from a business and financial standpoint. I think a lot of conversations always focus on cash and how do you get more cash, how do you get more investment, how do you find sales, which is all important. But let's bring this back to blocking and tackling. My background is in distressed and turnaround private equity. So I've had to work with a lot of great businesses who unfortunately were going through challenging times, like I think the broader industry is going through right now for clean tech. So without further delay, Dimitri, I mean, could you please provide an overview of yourself and then what you're doing with Enduring Planet and what motivated you to launch the business? Because I think everybody's motivated in different ways, and clearly you're doing great work. But what really was your impetus?
Yeah, good question. Thanks for having me today. Um, I agree with you. It is a challenging time, and I think that entrepreneurs in this space need to not only get creative, but get really informed on how these things can be navigated. I think a lot of the discussion I hear loses the nuance, and the nuance is what really matters. So I'm the co-founder and CEO of Enduring Planet. We are a finance platform focused exclusively on climate. We provide a mix of lending and what I would call like FinOps services for climate companies. So on the lending side, we provide short-term working capital to help climate entrepreneurs navigate cash flow challenges. Our loans are typically kind of 3 to 18 months. And we lend against all sorts of contracts, government receivables, grants, procurement, corporate, enterprise procurement, you name it, we can lend against it. And then on the FinOps side, we provide what I would call the like really bread and butter financial services that all climate companies need. So, bookkeeping and accounting, financial modeling, cash flow planning, budgeting, AP and AR, the things that everyone needs day to day to build good operating businesses. And we now work with over 50 clients across startups, nonprofits, you kind of name it within climate. If you're in climate and you need FinOps help, we do it. And I think for me, the motivation to start Enduring Planet was really just that I've worked in climate my whole career now, going on 15 years, 16 years. And time and time again, I would see companies struggle with both securing capital to build their
Mhm.
businesses, but then also managing that capital. And when we launched, we were originally just a lending platform, but we saw this really big gap in the FinOps space. And so we decided to expand into that basically last year. So now I'm proud to say that we're one of the leading providers of those services in the climate space.
So I'm going to come back to that, but taking a step back, right? So you've been in the industry, and when I say industry, climate and clean tech, right, for an extended period of time. Could you talk about some of the companies? I mean, you worked with a wide variety of companies today, but really, what are you seeing on the front lines? I mean, obviously, you're hearing the headlines, and I see a lot of companies struggling, funds are struggling, but there's a lot of different challenges in this environment today. Which, I mean, Dimitry, I think we had predicted that a couple of years ago, right?
Yep.
That this could be on the horizon. So, I mean, what are you seeing on the front lines? Are you seeing challenges, or are you thinking everything is still pretty strong?
No, it's definitely a hard time. I would say that this is probably the hardest time in the most recent 10 years for climate in the US. I don't know if it's the same in Europe. I think Europe has taken a different posture on the need for climate solutions to be successful. And so there's an insane amount of public support, which has, in the US has kind of come down with the new administration. But there are other dynamics in Europe that make it harder because there's a less developed venture ecosystem. There's a less developed, I would argue, credit ecosystem for climate specifically, but public support is very, very strong. In the US, there's been a pretty fundamental shift with Trump coming into power where federal support for climate has declined. It has not disappeared entirely. And I think this is something that is lost in the headlines. People are like, oh my God, there's DOE funding cuts and blah, 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 blah. There's still a ton of public money from the federal government for climate solutions. It's just often called something else, right? So explicitly in climate, there's still a bunch of money for critical minerals, nuclear, hydro, geothermal, but there's even still money for innovative technologies through SBIR programs that they might not call it climate, but they're still funding renewable, they're still funding grid expansion, et cetera. There's still also a bunch of support at the state level. So California just doubled down on climate investment. New York has big programs, Washington, Jersey. Yep. I mean, like you name it, there's lots of state programs. I think the biggest shift is that because of what's happening at the public level, most of the, I'm going to use this term intentionally, most of the tourist climate venture investors are pulling back. So they were like, oh, it's a hot time. There's all this public money. We'll ride that wave. Now the public money is going away. We're going to stop riding that wave. And also the performance of their portfolios has not been strong enough to support a second or third fund. And so there is a decline in overall venture funding in the space. But rounds are still getting closed. I mean, I see a new round announcement almost every day right now, which is actually feels like a shift in a positive direction from 6 or 9 months ago when people were just sitting on their hands. Like deals weren't even getting done, and now they are.
So it's an interesting point that you bring up because I think you talked about the tourist venture capitalists, but I think that was also, and this is one of my challenges I've had with the industry sometimes, is that we're not investors, and not this is more of a statement than like a hard fact, but just an opinion. Sometimes investors aren't helping working with businesses and building sustainable business models. So that if there's a shock to the system, like you had with going on from a political standpoint or a pullback in public financing, a lot of business models weren't really truly sustainable and they've been impacted. Is that what you're saying? Or do you think it's been, you need that capital? And the reason I'm going to get in, because it's kind of the foundation of what we're going to be talking about for the rest of this discussion.
I mean, look, I think that there's this false narrative in the market that some businesses are like fundamentally more sustainable without public finance than others, because there's a lot of public money that flows through lots of different avenues to these companies, whether they're directly benefiting from it or not. And
that's a good point.
I also think that when public money is available, as an entrepreneur, you should always take it because oftentimes it has a zero cost basis other than the reporting requirements, right? And so if I'm running a climate business and I can get public grants, I sure can I curse on this?
Preferably no.
Preferably not. Okay,
in Texas, we do not cuss, just saying for the record.
Okay. Well, I'm from Jersey, so I do. But yeah, like you should always take it, right? Unless the burden of reporting on that grant or being compliant with it is not suitable for your business. And so what I've been seeing, at least in the public comms of folks who have lost large public sources of funding, is that they're backfilling it with other sources of money. And so like there are announcements I've seen from a number of folks who are building large manufacturing facilities where, despite the fact that it's domestic, the fact that it like supports resiliency in the country, the federal government's decided to pull out of a large grant, right? Well, they're getting that money from the state, they're getting it from private investors, they're getting it from lots of other sources because those projects are viable and should be built.
Mm-hmm.
And so I think to your original question, like it's a really hard time right now. There's less money. People have to get really creative with how they navigate this period. But the folks who are building businesses and can survive and be resilient now are going to be incredibly successful, like as the market thaws, and it will thaw. Like this is, I would say, my guess, if I had to hazard a guess, which I try not to do because I'm often wrong, but I would say that this is the bottom.
The bottom.
The bottom. Yeah.
Okay. So you think that's an interesting point. Personally, I think they're still going to see broader ramifications as liquidity sources, I don't want to say dry up, but just continue to be, people have been able to withstand it, but we're right now 1 year in or less than a year in. So what can happen?
A year in. Yeah.
So, okay. So one question then, I mean, you talked a little bit about some of the non-dilutive sources of capital, other forms of public financing coming in from states and whatnot. Do you recommend, are there certain types of non-dilutive capital? I know you do a lot in working capital. We'll come back to that. But just in terms of sources, are you seeing, you mentioned state of California and New York. Are there other forms that people aren't, that they should have on their radar for the innovators and the investors in the audience today and in the future?
Yeah. So I think maybe first we should define that term, because I think oftentimes people use it in confusing ways. So when I say non-dilutive capital, I mean anything that's not equity financing, anything that doesn't lead to dilution. So that includes credit, debt, and grants, right? But if we're talking about sort of, let's call it grant money, right? Which can come from public or private sources. There's a ton of public grant funding for climate at the state, city, county level, right? So, and at the federal government. So, an example is the California Energy Commission, right? The CEC is like one of the largest providers of public funding for climate in the country. Cal Fire, Cal Recycle, lots of programs in California. New York has NYSERDA.
But do you have to be California based to benefit from it? Or could you be?
No, the project has to be in California, or the work has to benefit California. But it doesn't have to, like, the company doesn't have to be domiciled in California. It doesn't have to be headquartered there. You don't even often have to have employees in California to do that work. NYSERDA is another great example. The CEC, Massachusetts Clean Energy Center. There's so many of these programs. Now, they're super competitive. They're only going to get more competitive. But companies that are smart about diversifying their capital stack and accessing public money can be very successful. And like, again, the money from the federal government is still there. We lend against federal grants. There's actually way fewer cancellations, and I mean, almost none in our portfolio that we've seen. And in some cases, what companies are doing is they'll get a cancellation from the federal government. They'll go to their state and they'll say, hey, we just lost this grant at the federal level, and the state will actually fill it for them. And so people should really make sure that they're closely connected to the sort of points of contact within their state government where they are operating, because they can often get support to sort of fill these gaps.
And it's a good point. I mean, obviously, EarthX, we are apolitical, we're bipartisan. We get a lot of different perspectives, and especially based in Texas, we sometimes get more conservative perspectives. But there's a lot of capital, not just in quote unquote blue states, but there's also a lot of capital opportunities. You just have to be creative in how you think about it. So we had Commissioner Sid Miller from the state of Texas speak last year in 25 during our eCapital Summit. And he talked about a lot of the innovation that they're doing from an ag tech standpoint. You have a lot of different folks. So just finding the right pocket of capital that supports what you're working on. So that's one of the points I wanted to highlight from this. So I appreciate you bringing that up, Dimitry.
Absolutely. And I think it's also important to remember that people might not call it climate in other places or across the country. Like, the words change, but the work is the same, And so what's really important is that as an entrepreneur, like if you're a founder thinking about your capital strategy, you better have either internal functions that track public funding for the kind of work that you do, or work with a partner. So for example, we're big fans of a group called Climate Finance Solutions. They help climate companies win grants. They have a tracker that they just built that will tell you, based on your company's profile, what public opportunities are available to you at any given time.
Mm-hmm.
And
So there's a
so,
lot of great companies like that out there, right?
yeah. I mean, we've seen some, I would say, some reduction in the number of companies that are supporting this type of work, just because it's hard. But CFS is going strong.
Okay. I mean, you mentioned this when you were giving an overview of Enduring Planet. When you first started the business, and then I'm going to go into the financial ops side, but just thinking about from a capital standpoint, how do you navigate? So we talked about non-dilutive, other forms of non-dilutive public financing, but then there's private credit, and the big part of private capital credit is working capital, right?
Yep.
How do you actually pay your bills? And that's what I try to explain to people. Profitability doesn't always mean positive cash flow. And I think people get that mistaken. And I remember when I started my finance career, somebody said cash is king. And I never appreciated it until I worked in distress. So can you talk a little bit about the different forms of working capital that exist today? And I know that could be a topic for hours, right? But
Yeah.
reality is, what are the most common high-level forms of working capital, right? Like ABLs, you have
Yep.
PO financing. I mean, there's all different types, equipment financing. But can you talk a little bit, some about the high-level types of working capital solutions, especially for people who may not have any background in this, because a lot of companies don't have a CFO and they don't have the experience you have. And then separately, talking about what are some of the more bespoke solutions you've seen being developed, maybe in particular for clean tech related businesses?
Yeah, and I think this is another term that gets thrown around that's probably worth defining, right? So um, when we talk about working capital, what we're talking about is the cash that's required to achieve the goals that you have in your business. And sometimes your working capital needs are supported by equity, sometimes they're supported by grants, and sometimes they're supported by debt,
Mhm.
right? And it's all a question of the outcome that you're trying to fund. And this is something that I spend a lot of time with founders on, is like you aligning your capital sources to the thing you're trying to actually accomplish. And I don't mean that at a corporate level. I mean that on an individual outcome basis. So let's say you're doing innovative R&D and you don't know when you will develop that product, when you'll be able to sell it, how well it will sell, who will adopt it, et cetera. You're still just in that R&D phase. Generally, within that time, the best funding sources are equity and grants, right? Now, having said that, if developing part of that R&D
Well, sometimes
is,
that's only the only capital that's available to you.
oh, well, yes and no, right? So now, having said that, let's say you're a company that's in that process and you need to buy a piece of equipment. That's a lot of CapEx.
Mhm.
The equipment has predictable value, it has residual value, right? And so in that context, you can either borrow money or lease that through equipment financing, because the outcome is predictable. The outcome being, oh, if something goes wrong, that equipment can be sold, right? So now you have a company that's very early, that has an unpredictable outcome broadly, but has a very predictable, narrow thing that they need to do. And so this is where I think debt plays a really important role. So companies that are not profitable are often told they can't access debt because people have an antiquated perspective on how lending works. They're like, oh, banks require 3 years of free cash. You can't borrow money. That's not true anymore. There's a massive universe of private credit options for people where they can take what would historically have been either a cash flow problem or gap and support those needs with credit. And so, for example, in our case at Enduring Planet, what we do is primarily lend against contracts. 95% of our borrowers are not profitable. Okay, that is not a requirement
So
for
let's
us.
repeat that: 95% of your borrowers are
Are not
non-profitable.
profitable. Yeah, in fact, maybe like 90. Yeah, 95 at
But
least, right? And we have a perfect repayment track record. Okay, so across our government advanced lending and term loan portfolios, we've never had a loss.
and how many are you able to
Knock
share
on wood.
publicly how many companies you've worked with?
Over almost 70.
It's a pretty good hit
And
rate,
so,
especially.
yeah. So, and this is not, I'm not soliciting funds or fundraising or anything like that.
No, no,
So
you're just
the
explaining what you're doing.
disclaimer,
Yes.
the disclaimer is here, right? So, and we lend as early as companies coming out of a national lab with a grant from the state of California to do R&D, and we'll provide them the working capital to support that project. Because one of the things that a lot of people don't understand about grants or even contracts is that you never get paid up front. It's always reimbursement based, which means you have to have the money to spend the money to do the work, to submit an invoice and a report and get paid. And this is true for if you're selling to Facebook or if you're selling to the government or if you have a grant. In all of those cases, almost always you get paid at the end or on a milestone basis or on a deliverable basis. And so for a lot of companies that where the grant or contract requires a significant outlay of capital, they might not have the balance sheet to just sit on that call it AR for 6, 9, 12 months. And this is where we come in. But there's a lot of creative credit out there, right? So there's equipment financing. You said, PO financing, which is effectively what we do. There's invoice factoring, which is a little different. There you have to have done the work, submitted the invoice, and then you can basically sell the invoice at a discount to a lender. They don't often call themselves a lender because they want to skirt lending regulations. They are lenders. They're just
They're
buying your
factors.
receivable. Yeah, they're factors, right? There's also, I think, like some creative products like revenue-based financing out there. We used to do RBF. I would never do RBF again.
So
I think it's
can you explain RBF for the audience?
yeah. So revenue-based financing is where you borrow money against an expected future revenue start. Basically, you're saying, okay, we're going to grow, 2x year over year for the next 5 years. The lender agrees that you will hit that thing. And so they are like, here, we'll give you $1 million and you give us 5% of your revenue for X period of time or until you hit this repayment cap. And a lot of people really like that product. We did about a dozen of those deals. And in retrospect, it's like not a good credit instrument because when it works really well in a very narrow band of borrower lender relationships. And outside of that band, you either have a lender who is being very extractive because the company's overperforming their revenue trajectory and the lender is getting like a 30, 40, 50% IRR on the deal. And on the other side, the lender is taking disproportionate risk and is offering capital at a price that does not match the underlying
risk profile.
Profile. And what a lot of lenders do is they'll put in place safeguards to protect their investment. And then it basically becomes like a term loan with upside, which is like not a fair allocation of risk in a credit scenario for a company. And so there's some narrow band where it works really well, but otherwise I don't recommend it.
Okay. Just one last question on this, just to wrap up. I mean, you talked on different working capital solutions. Are there different specific types of firms that you see that are offering these types of products? Is it more philanthropic, more investment based? Do you find certain people to be most creative? I mean, who should people have on their radar? If you can't share specific names, but just types of folks that people can then go to my best friend Google and look it up.
Yeah. So the universe is pretty vast. Climate Tech, CTVC actually we jointly collaborated on a big working capital playbook for the ecosystem. I don't know can I drop links in the chat here?
No, but we will share with folks afterwards.
Okay. Yeah. So that's a resource out there. We also publish about this on our blog. We write weekly posts for tactical financial insights for climate founders. So we've talked a lot about these questions, but on the equipment finance side, we see a lot of opportunity. We partner with Caneo, Camber Road, LSC, Farnham Street. On the contract finance side, which is what we do, there are other players out there, but honestly, in climate, we're the best. So come work with us. There are lenders who we partner with who do larger tickets. So we're big fans of Pace Zero or Generates Credit Team. Galway has a program here. Blue Owl. There's a bunch of these players. The biggest gaps that we see in the market are in the $100K to $10 million range. Turtle Hill's another great lender in the space. But a lot of these folks, they prefer to operate in that call it really minimum 5, but generally 10 plus range. And so folks that are earlier, like there's not a lot of options outside of us. Lacey has a small credit fund, the Los Angeles Clean Tech Incubator. I'm certain I'm forgetting someone right now, but people can
We
always
won't
reach out
hold
to me
that
also.
against you. So there's
Yeah.
no. Okay. So like switching gears, because we talked about the capital, we talked about what's going on from an investment standpoint. We talked about how do you fill the gaps, both with public grant money, and then how you can look at creative debt solutions. But at the end of the day, you still need to have a sustainable business, right? And you need to be operating in a financially, I don't want to say creative way, just in a prudent way. And I think there's a
Yeah.
a lot of folks aren't physically responsible, not because they don't want to be. They sometimes get told the wrong story from sometimes their equity investors, from the industry in general. They're told just to focus on revenue and that they'll keep getting funded. And then when the revenue stops, or I'm sorry, when the funding stops, they're stuck
Yeah.
holding
Yeah.
the everything, right? So why did you start offering financial operation services to companies? And then what has surprised you the most when you're thinking about when you've been working with startups? Because a lot of these founders, some of them have a finance background, but a lot of them don't, and they nor should they, because they are coming from an engineering standpoint, they're coming from a policy standpoint. I mean,
Yeah.
there's so many. I'm fascinated by the intelligence and the entrepreneurism I meet of so many great founders, but they shouldn't get tripped up in the financial side. So I'd be curious to
No.
get your perspective of why you started this, and then what are these challenges that you've seen? And we can dive a little bit more into it deeper, but just at a high level.
I mean, so we always envisioned that Enduring Planet would be a platform for founders to navigate these capital challenges with lots of different services. And one of the things that we kept seeing time and time again from prospective borrowers, that folks would apply for money and they'd be like, "Oh, we haven't updated our books in 9 months," or "Oh, our accounting firm is really late," or "Oh, they didn't know how to actually handle this thing, so it's like hasn't been done in 3 to 4 months," or whatever. Like all of these excuses. And then the other thing that we would see is that people would have their finances handled externally by a fractional firm, but that firm would have no expertise in their space. And so the model would be really rudimentary or just like a template. Like we see a lot of folks coming from um, a, a provider that starts with the letter P that I won't name, where it's just like cookie cutter products that are being pushed onto companies where their chart of accounts is not aligned with their business, the model's not aligned with their business, their reporting frameworks aren't aligned with the business. It's like, oh, let's use SaaS metrics for a hardware company. Like, no, right? And so we just saw this over and over and over again. And we kind of looked at ourselves and we said, okay, well, what do we know how to do, right? We underwrite companies, so we spend a lot of time looking at their accounting, and we actually have accounting experts on our team. Huh? Oh, we build financial models for businesses who come apply for our funding because we have to understand their forward-looking cash flow and receivables. We're really good at modeling, huh? And so we said, okay, well, why don't we go test this with the market? And we reached out to a few of our borrowers and we said, hey, like we noticed that this has been a problem for you. Could we take this over for you? And it very quickly became apparent that we had an opportunity. The other thing that I think is probably important to note is that we have figured out a way to have a cost basis that is pretty hard to compete with in the market. So almost the entirety of the Enduring Planet team is actually based in Pakistan. We hire all of our finance talent in Pakistan. We've built like a really strong talent pipeline there. We have a training and onboarding process for all of our employees that really builds the kinds of skills and understanding of the climate space that are very unique to us. And so that means that when we show up for a client, like people can come to us and be like, oh, well, we have this really complicated business with tax credits and equipment financing and project financing and this. And we're like, hey, we've done this like a dozen times now. Here's the thing that you need.
Yeah.
And it's honestly like, I'll tell you, when we started, I had no idea how it would go. I was really nervous. I was like, this is a cool idea and it's going to be a great way for us to navigate our own cash, right? Because it's a cash flowing business.
It's a business. It's a new service line.
It's a business. Yep. And a lot of people were like, well, this is like, you're a venture-backed startup. Why are you running a services business? And this doesn't scale. And there's no way you can grow this quickly. And hate to say it, but like it's been a freaking rocket ship, and it's been really awesome to see. And it's a profitable stock. It's like a profitable part of our company, which is
No, I
really
love it.
exciting.
Listen, I mean, again, I talk to people, and when I'm speaking to entrepreneurs or I'm speaking at conferences, I'm like, focus on building a sustainable business model, understand the nuts and bolts of your company, because having a great corporate finance function will just drive better analysis
So
and
this
support.
is the thing that I think a lot of founders, um, you sort of pointed to this earlier in the question, right? Is like, um, we talk to entrepreneurs all the time where they're like, oh, we're really focused on building, we're really focused on selling, we're really focused on closing this contract. And I'm like, cool. You have no idea how your what your financial position is right now. Like you have no understanding of accounting standards, which help you understand like how costs and revenue accrue, because that's an important thing to like really get ahead of as you like build a company. You think you understand your runway, but you actually don't, which is incredibly important, right? I can't tell you how many times we've had a client come to us and say, hey, so we messed up in our books and we thought that a payment was coming, but it actually already came 6 months ago. And we went from 9 months of runway to 2. Can you help us? And we're like, yeah, well, if you had a good team behind you, this entire time, this was been totally avoided, right? And so I think that people like entrepreneurs are taught to like really focus on product, really focus on customer discovery. And it's like a lot of we've seen VCs fund like a $5-10 million seed round, and the company has no accounting established. And I'm like, you as investors are bad fiduciaries, because how do you know that they don't have $20 million worth of debt on their balance sheet that just isn't there because there's not a balance sheet to look at? Um,
And
it, it's
so,
bonkers. Yeah.
so when I look at a business, and like if I'm doing a turnaround, or if I'm looking at from an investment standpoint or trying to turn around a business, right? Everybody has their different frameworks. I have what I call my 5 Ps. It's the people, the product, the plan, the processes, and then what I call plus, which in all of those 5 buckets, finance touches all of them, right? You need
100%.
people, you have financial leadership and general operations. Under product and plan, understanding unit economics and like understanding your cash conversion cycle from your supply chain through customer payments. It's not just because you get a make a sale means you get cash immediately. You have to source your product, you have to put deposits down. Sometimes that cash conversion cycle in consumer products can be 180 days, if not longer.
Yeah.
Um, and so it's understanding the working capital needs. It's processes, the point that you mentioned, right? Do you have the right financial processes in place? Do you have a culture of excellence? Do you understand accounting? Given these different areas, I mean, obviously startups don't benefit from having infinite resources or infinite time.
Yeah.
What do you see are some of the greatest gaps that a lot of companies have had or have today that they should be mindful of? And
Yeah.
then why do you think that's the case, and what can they do with to fix those on a short-term basis?
Yeah.
And then
So generally the guidance that I give founders is um, you don't really need a lot of this infrastructure until you take on outside money. Right. So if you're just two founders grinding away, building a thing, doing customer discovery, yeah, you should like register a business and have like basic books set up. You can use a free platform like Wave just to track
Mhm.
stuff. It doesn't have to be super accurate. The moment you take on outside money, your first angel check, you should have an outside party handling your books. It doesn't have to be expensive. You can do cash-based accounting for 250, $500. It's not hard, right? Um, but the key here is that you are now responsible for other people's funds, and you are liable. You are liable. And you don't want to make mistakes. And it's not hard. It's not expensive. It is worth doing, right? Now, once you've raised your first institutional money, so like call it your pre-seed round, your first couple of $1 million, whatever you want to call it, or your business is big enough that you're doing at least $500,000 in revenue, you should have a very clear sense of how cash flow works. It can be a simple cash flow budget. You don't have to have a full pro forma yet, but you really need to understand how your cash moves in and out of the business, where you're going to have gaps so that you can adequately prepare for those, right? And what that might mean is you need to push out payments. You need to negotiate different structures with buyers or partners. Maybe people need to prepay you for stuff. These insights are not possible without a good cash flow model. And then as soon as you either raise your next round or you start getting big enough, call it $1 million in revenue, you need to really have an accurate corporate pro forma that projects way out. And you can understand on a monthly basis how cash is going to work, when you need to raise debt, when you need to raise equity, where a grant could be helpful. Like these insights are not replaceable. They are like a minimum table stakes, right? And then on all of this, you could start to layer other things, right? So the way that we generally like to think about it is like founder time is worth some amount of money. And every founder can price their own time the way they want. But generally, I would say like you should be thinking about your time as like like $500 an hour. That's a good metric. And anytime you can hand something off to someone to like handle your bills for you or handle collections from customers for you, and you can afford it, you should always do it because your time is so valuable as an entrepreneur. And oftentimes we see founders really struggle with this because they're like, oh, I built this, I just do this stuff, it's fine, I'll do it on the weekend. But the problem is like it slips, you forget, it's not accurate, mistakes are made, and it's often the cost of having someone else handle it for you is totally worth it.
Yeah. Taking a pause. If you guys have, I know we've gone some questions already, but if you have any questions, please put them in the Q&A section at the top of your screen and then I will be able to ask them to Dimitry. But Dimitry, you mentioned cash accounting versus accrual accounting. You hinted on that. A lot of people may not understand what the difference is. Could you just give a I know you're not an accountant per se, but if you could just give an overview of what people should be thinking about.
So the simplest way to think about cash versus accrual is when you're doing cash-based accounting, you track money as it comes in and goes out, right? But with accrual accounting, you align that money to the time period in which the work is actually done. So for example, revenue is not accrued until the work is completed and delivered, even if a customer pays you 6 months prior, right? And the same goes for costs, right? So just because you paid a vendor today doesn't mean that work is completed in that moment, right? And so you sort of start to add this time element to your accounting. I would say that generally, if you're a venture-backed company and you have institutional money, you should be on an accrual-based accounting system. It is way more. It allows you to have a better sense of how your business is actually operating because it like for example, if you get paid 500 grand by a customer to do work that takes 12 months, you didn't necessarily get that 500 grand. You didn't earn that revenue. You're going to have to earn it over the next 12 months, and you're going to have a cost associated with earning that revenue over that 12 months. Yeah.
Makes sense. Let me see some of the questions that have come in. So, because I do want to dive a little bit deeper into a couple of cases. But before we do that, one question that's popped up is, can you talk a little bit about some of the early signs that companies should be watching out for to avoid financial stress?
Oh, man.
I mean, I can mention some from my side.
Yeah, I mean, look, I think obviously, so one of the things that we recommend to all founders is that there's that looking at financials is really important to do on a time basis, not in an individual moment, right? So if revenue, if you're like, for example, a simple metric to track, right, is like revenue, top line revenue, right? You should also be looking at the revenue growth rate. And you should be looking at whether or not your revenue and revenue growth rate are consistent, right? Obviously, if they're going up and improving, great, you don't have to worry about it. But if you're starting to see changes in the rate, that's a place where you should ask questions, right? The same is true of your cost of goods sold or your COGS or your cost of revenue, right? That should constantly be improving, right? And if it's not improving, and COGS are going up, then that's a place to track, right? One of the things that we do for all of our clients is that we will build a dashboard for them that tracks all of their main expenses and the changes in those expenses over time. And so if you're starting to see, let's say, the consultant costs go way out of bound, that's a place to check in with your team and be like, hey, are we overdoing it on hiring outside parties to give us advice, right? And so I think it's very business specific, but the really main things to worry about is cash and runway, right? For any company that's not profitable, the thing that you need to be very, very careful of is like, when am I going to run out of cash? How accurately am I predicting that? And what actions am I taking early enough to address that? And oftentimes founders think about fundraising as like a 3 to 6 month thing. That is not true anymore. A lot of companies will spend a year raising a bridge round right now, which means you need to start it 12 months early.
No, it's a good point. Can you talk a little bit more about, so just for the benefit, this is kind of a good tie up before we go into the Q&A, because we've got another great question that just popped in. But talk about a case study that you worked with a founder on how you advise them, either from a financial operations standpoint, any profitability metrics that you can talk about. I have a couple of case studies I can discuss, but I would be curious to get what you're seeing, especially from a sustainability climate tech perspective.
Yeah. So, on the lending side, we actually post case studies on most of our deals on our website. People can go check them out.
What's your website, just for everyone's benefit?
enduringplanet.com. And if you click, there's an about and then a case study section. You can go look at all the deals we've done. I would say that, a recent transaction that we did was with a company called Westwood Aerogel. They're developing innovative insulation materials. And they have a big prototype development grant from CalSeed in California. That grant pays based on reimbursements and delivery. And in a lot of cases, you have to kind of buy equipment and then do some work and then wait for a report to get submitted. And so we provided them financing to accelerate that work. And they were able to do it faster, more easily, without locking up, without having to raise more equity capital. The great thing about the lending work that we do is that oftentimes it's saving people a lot of dilution, a lot of pain at a time when fundraising equity is very, very hard, right? On the CFO side, we have so many clients, it's hard to focus on one, but what we're seeing is that a lot of folks in our portfolio are really benefiting from these additional insights around their what I would call FP&A work. So budgeting, cash flow budgeting, pro forma. We've had a lot of our clients raise substantial rounds of funding using our products, right? So one of our clients just raised a monster Series A. I don't want to name it because it's confidential, but our pro forma was a key part of their fundraising process. And so we also, maybe this is something you can include, but we decided to join Sam's List, which is a database of financial advisory professionals for entrepreneurs. And I'm pretty proud to say that we're actually the highest rated CFO firm across the entire platform, even though we just serve climate companies.
Okay. So one question that's popped up, it's right, it's always talks about buy-in. There's always a push and pull relationship between investors and companies, or lenders and companies, or grantors and grantees. So an interesting question that's popped up, it's many founders in a grant portfolio sometimes just don't respond or actually submit the information that they're supposed to. How do you find any best practice to convince early stage founders to look into really tracking their financials sooner? Which is a good point, right? Because a founder is gonna be to your point, they're trying to focus on how do you drive sales, how to get their product to market, how do they build their product? How do you make them realize that if they don't do this, because they can always look back in the rearview mirror and see, I wish that I had done this better 6 months, a year, a couple of years ago, but they don't prioritize it right now. How have you been able to get founders to really prioritize this?
Well, I think it depends on who's the active party in this, right? If you are an investor, if you're a foundation giving a grant, if you're the government, whatever. So a lot of federal grant programs require you to have the financial infrastructure to report. And once you get big enough, they require audited financials. There's capstone reviews. There's all this stuff. So the funder is the one saying, hey, you have to do this. We're not going to give you money if you're not going to do this. And
what if honestly, they don't even got the money and then it's future?
No. It's like a core part of the standard public procurement contract. There is no option not to do it. Right. And this is actually something that I would say most investors should do. If you're an angel investor, this does not apply to you. But if you're writing real institutional checks, a requirement of your financing should be that you get like third-party prepared financials and ideally a pro forma every quarter, every month, every year, whatever timeline you want. So unless investors require it or foundations require it, people won't do the work, right? I do think that it's important to align those requirements with the quantum of funding. So if you're like a pre-seed fund writing a 50K check, and you have onerous reporting requirements, you're just being like, that's not helpful to anyone. But whoever the lead investor is writing the biggest check, they should set the stage for what good reporting looks like. And then I think from our side, like what we do is we just try to educate founders on these challenges, right? We're like, hey, you should know that this is a risk you are running if you don't have this in place. Mm-hmm. And there have been cases where we've done loans with companies where we're like, hey, we're willing to proceed even though your books are garbage because we see your banking data and we can kind of figure it out. But a condition subsequent of our funding is that within the next 30 to 60 days, whatever the timeline is, you have to fix this problem. And then you can work with anyone. You can work with us, you can work with someone else. We don't really care, but it needs to be fixed and we need to see the documentation. And so sometimes that's also an option for folks.
And then what I try to explain, especially if it's engineers or folks who come from a process standpoint, I say like, listen, your financials is just another tool set, a data set that you can look at that just gives you a better sense of what's going on from your business so you can make better strategic and operational decisions. You can see if your unit economics are profitable. I remember I was working at the business where 25% of their revenue was negative gross margin. And they were a manufacturing business. And they said, and I asked them, I said, why? And they're like, oh, we always thought it was negative, but like I had built a model for them that showed that. And the response was, well, Vikram, the workers are really happy because they're staying busy. And then a response, and I mean, I flippantly said this because I was kind of, pardon my language, pissed, was that how happy are they going to be if the facility shuts down? But they would not have known that their product was that customer was negative gross margin because they'd never done the upfront analysis from a unit economic standpoint, or they did, but then reality sets in from a manufacturing. And any model, any monkey can build a model, right? Anybody can build. It's all about your assumptions, but reality versus what you pro forma are two different ways. And the worst thing I hate is when somebody gives me a pro forma model and they just say, oh, revenues are going to grow 20% per year or 10% per year. And I'm like, why? Is it because you're selling more volume? Is it more greater price? Is it a different mix? How does your profitability look like? And that gives you the levers to be able to pull strategically. So one question that's popped up, and I'm going to give you a twist on it a little bit. So we had somebody who's a nonprofit. And I know we've been focusing mainly on for-profits. And I don't know if you guys work with not-for-profits. Obviously, there's been a significant gap. So if you could spend a few minutes, and I know we're almost getting at the end of the hour, but I would love to touch on non-for-profits because that is obviously a significant funding gap that exists today. And I'm sorry that I didn't harp on it earlier. Could you talk about what are you seeing from the not-for-profits? What are the revenue opportunities there? Because obviously not-for-profits have the same working capital needs that for-profits have. And then have you ever dealt in a relationship where there's a public-private partnership with a foreign entity?
Yeah.
So if there's anything you can share with those.
So we do work with nonprofits on the CFO side, on the FinOps side. We don't lend to nonprofits today. There are folks who will do bridge or working capital lending to nonprofits. Oftentimes those folks are using charitable capital to do so. A good example, we're big fans of the Open Road team. Open Road does bridge lending for nonprofits against, sort of like the types of issues that we try to solve for climate for profits. I think that obviously the decline in public funding for nonprofits generally, but also especially in climate, has been incredibly disruptive. I cannot it's way worse in the nonprofit space than it is in the for-profit space today. And I think that, folks are filling that gap however they can. It's a lot of relationship-driven fundraising. It's a lot of individual donors. There's, state and city and county funding available, but it's pretty rough. And there's a lot of nonprofits that are dramatically downsizing. They're folding. It's not a good time. I think foreign funding is a great avenue for folks to pursue. And working with public sources of funding internationally is great. Yeah, you just have to make sure that you're staying compliant, that you can access it. You might need to have a local registration. There are things that people can do to make it easier. So there's, at least in the US, there's the concept of fiscal sponsorship, where you can have a partner who is a nonprofit or 501c3 basically act as your pass through to receive funds. So you don't even have to have 501c3 status yourself. You can get a fiscal sponsor. They can receive grants on your behalf and then pass them through to you. And that way you stay compliant until you can get your own 501c3 status, or it even makes sense for you to do so because it's like a regulatorily complex
Then there's
thing.
a lot of different paths. I know what you're talking about. Just to be, how do I say that? A disclaimer, there's a lot of pros and cons, and there's a lot of regulatory things.
This is not legal or finance advice.
Yeah, this is not legal or
an attorney. Yeah, please go talk to an attorney.
Yes.
Please go talk to your CPA. Please go talk to your tax advisor.
So,
yeah.
Well, listen, on that note, I mean, Dimitry, thank you so much for your time. This has been, listen, we've had a lot of good webinars. This has been one of my favorite ones because I think the more that we get people to think about fiscal responsibility and looking at financial operations and really building sustainable business models, because the one thing that you can control is your costs. That's the one thing I always try to tell everybody. You can control your costs. You can control how you analyze that. You can't control revenue. As anybody would love to be able to do, you can. So the more fiscal responsible you are and the better you're operating is better. And I think this is really good information, Dimitry. I think you're a wealth of knowledge. I've always thought very highly of you and the important gap that you're filling in the market and your team. And I think people will really benefit from that. So hopefully we'll have you in April at the 10th annual EarthxCapital Summit, or maybe somebody else that you recommend. But we want to continue these conversations. And for everybody out there, these are the types of discussions that EarthX wants to have. If there's any topics that you think are really missing in the market today, please let us know. Email us at ecapital@earthx.org. And I hope you guys have a great rest of your day. And Dimitry, thanks again for your very, very valuable experience, which I know is worth a lot more than $500 an hour. So thanks everybody for your time today.
Really appreciate it. Take care.
Appreciate it.